Hello everyone, thank you for watching this video. We are here with Witold Bahrke, macro strategy of Nordea Asset Management. Witold, thank you so much for being here with us with this interview for Finect. And we're going to ask you about how do you see the world right now? How do you see Europe with this political risk?
Well, just in general terms, for 2017, we see three main themes that we really think will shape the investment landscape, but also the global economy. And first of all is, where are we in the economic cycle and in the asset return cycle? That's very important. Secondly, what's going to happen with monetary policy? We see some different developments depending on which region we are in. And I think monetary policy is in a transforming role right now, which investors have to be aware of. Lastly, I would say political risks. Now, it's very apparent with the US election, but also if we look beyond the US election, we see structurally rising political risks, which investors have to take into account, although it's very, very difficult to know how to price this. Now, that brings me to Europe, because Europe, when we're talking about political risks, is really front and center when we think about 2017. We have a lot of elections. We have elections in Germany, we have elections in France, we have elections in the Netherlands. So when we're talking about political risk, we have to think about Europe. I think these risks are very pronounced in Europe. And of course, we have to be humble. We are economists by training. We can't predict political events, but we just have to make sure that we will not get hurt too much if we again are being surprised by any outcome that no poll has predicted.
That's kind of a trend right now. All the polls are wrong, kind of.
And the question is, have we learned anything? I would say probably not, because it's very difficult to draw the lessons. I mean, other than just, don't pay too much attention to them. That is a lesson, of course, but that does not tell you, okay, how should I invest, let's say 4 weeks before the German election or something like that. We just have to acknowledge that these risks are rising, these political risks. They can be two ways. They not necessarily have to be risk off all the time, but they are not following a certain distribution or so. So it's very hard to say, okay, the risk premiums in different asset classes or different asset classes as such will be affected in this and that way. As a good example, Trump won the election. Ahead of the election, the most skillful analysts out there were asked, what will happen with assets if Trump wins? Most of the people were pointing into a very defensive direction, i.e. then in a risk-off reaction. We got exactly the other side, the opposite. Yeah. So the question is really, in my view, you just have to be humble, right? Mm-hmm.
And talking about Trump, how do you see he's going to manage his government? He's going to do all the things he wants to do, or what's going to happen?
Basically, there are huge question marks behind all this. We don't know how much he will deliver relative to the promises he made in the election campaign. But I see two possible outcomes. Mm-hmm. The first one is a positive one, where all the stimulus that he will launch will benefit the world as well as the US. I.e., he will bring up fiscal spending to some level without adding too much protectionism to it, so that there will be positive spillovers to Europe, to the emerging markets. And that will, I call it the twin deficit scenario, because that will probably mean that the twin deficit, i.e. the budget balance, and the current account balance in the US will go more into negative for the benefit of the rest of the world. That's one scenario. The other scenario is what I would call a bit of a stagflationary scenario, where he actually sticks to what he said in the campaign, where he stimulates the economy, but he'll also add some protectionist measures on top of that. He will curb immigration. That is all pointing towards more domestic inflation, because he probably also will bring up minimum wages to kind of please his electorate. And more trade restrictions will probably also mean higher inflation. And it might squeeze margins in the US further down the road. Initially, it might be positive US. but most importantly, it will not benefit the rest of the world very much. So in that case, the benefits are tilted towards the US, whereas all the negatives are tilted towards the rest of the world. And that is, unfortunately, I have to say, so far the most likely scenario. Because when we just remember what he said on the TPP, where he basically opted out, that is not a good signal relative to large-scale trade agreements pointing into a protectionist direction. So that is probably where we go, and that would increase global divergence, i.e. the US will do relatively well, but the rest of the world will not really harvest any benefits from that. And a more divergent world means probably also a stronger dollar, and that means higher financial risks, especially in emerging markets.
So what's going to happen with them?
Well, I think to some degree, we are likely to see a bit of a 2015 déjà vu where some of the same, scares around emerging markets are reappearing. Okay. We already have seen a stronger dollar. I think the dollar is roughly up 9% since the lows earlier this year. I think it's most likely, given the policies of the potential policies, Trump policies we discussed before, it's more likely that the dollar goes up than it goes down. So the dollar scare will hurt emerging markets. It will probably also, at some point at least, hurt commodities, because most commodities are traded in dollars. Yeah. All in all, I think emerging markets will be a difficult place in 2017. I'm not predicting any major emerging markets crisis, but just to give you an example, we already saw some small outflows again from the Chinese currency reserves. They have so far been orderly, but if the dollar goes much stronger from here, we might again see an accelerating outflow there. And that basically reduced currency reserves means it's a bit of the same than reversed QE. Because these currency reserves, they are consistent to a large degree of government bonds, and if they sell them, that put further upward pressure on rates and downside pressure on prices and government bonds. So that's also very bad for global liquidity conditions. So I think it's worth paying a lot of attention on these aspects in emerging markets. Be
selective. It means it looks like it's the magical word, kind of.
Yeah, of course you have to be selective. In a baseline scenario where we don't see a major EM crisis. But if things really turn sour, and if headwinds are stronger than we expect, headwinds for emerging markets, then I think it will be difficult in such a scenario to find places to hide inside emerging markets. Because when everybody runs to the door, right, there's a queue, and then you just sell everything that is slightly correlated or somehow correlated to emerging markets. So if you say you have some emerging markets bonds, you can't get rid of them because of lack of liquidity, then you better sell emerging market equities, right? Yeah. Because that's correlated.
So a difficult year we are going to see in 2017.
I think in emerging markets, more difficult than 2016, definitely, yes.
Thank you so much, Witold, and thank you guys for watching this video. See ya.